Alright, before we dive in, a quick but very important note. I am not a financial advisor, and this presentation is for educational and informational purposes only. The ideas and strategies discussed in this video should not be considered personal financial advice. Investing involves risk, including the potential loss of principal. Please, always do your own research and consider consulting with a qualified financial professional before making any investment decisions. Your financial situation is unique, and you need a strategy that's right for you. Does the stock market feel like a secret club you weren't invited to? You turn on the news and you see a wall of flashing green and red numbers, charts that look like heart monitors, and experts yelling at each other in a language you don't understand. Dow Jones, S&P 500, NASDAQ, bulls, bears, PE ratios. It's overwhelming. It feels like you need a PhD in economics just to understand the conversation, let alone participate. Maybe you have a 401k through your job and you get those statements in the mail. You open it, look at the big number, and have absolutely no idea what's happening behind the scenes. You just hope it's going up. What if I told you that the entire US stock market, this massive, intimidating engine of the global economy, is built on a single, incredibly simple idea? An idea so simple you already understand it. In fact, if you've ever bought a pizza with a friend, you already get the basic concept. Over the next 10 parts, I am going to pull back the curtain on Wall Street. We are going to demystify the stock market together piece by piece. This isn't for day traders or hedge fund managers. This is for you, the complete beginner. The person who wants to understand how their money can work for them, how to build long-term wealth, and how to finally feel confident when they hear people talking about the market. We're going to cut through all the jargon and all the noise. By the end of this series, you won't just understand the news. You'll understand the game. You'll have the foundational knowledge to make smarter decisions for your future. So let's start with the absolute basics. Why should you even care? The simple answer is a word that affects every single one of us: inflation. Inflation is that silent thief that makes the dollar in your pocket worth a little less every single year. The coffee that cost $3 last year costs $3.50 this year. If your money is just sitting in a regular savings account, earning next to nothing in interest, you are effectively losing money every single day. You're losing purchasing power. The stock market, for all its complexity, has historically been one of the most powerful tools for everyday people to not only keep up with inflation, but to beat it. It's a way to grow your money over the long term. It's not a get-rich-quick scheme. It's a get-wealthy-slow plan. It's about participating in the growth and success of the greatest companies in America and the world. So what is it? Forget the flashing numbers for a second. At its heart, the stock market is just that. A market. It's a giant virtual marketplace where people buy and sell tiny little pieces of ownership in public companies. That's it. Think about it like this. Imagine your favorite local coffee shop. It's amazing. The coffee is perfect, the service is great, and they're always busy. The owner wants to expand. She wants to open a second, then a third location. But that takes a lot of money she doesn't have right now. So, she decides to sell small pieces of her business to the public to raise that money. She divides her entire coffee shop business into, say, 1,000 equal slices or shares. Each share represents 1,000th of the ownership of the entire company. Now you love this coffee shop. You believe in it. You see how successful it is, and you believe it's going to grow. So, you decide to buy one of those shares. You give the owner your money, and in return you get a certificate, a piece of paper, or these days a digital entry that says you are now a part owner. You own 1,000th of that coffee shop. That's a stock. A stock is simply a share of ownership in a company. When you buy a share of Apple, you are not just buying a product. You are literally buying a tiny microscopic piece of the entire Apple Corporation. You own a sliver of every iPhone, every MacBook, every patent, and every dollar in their bank account. You become a part owner. The fancy Wall Street term for this is equity. When you own stock, you own equity in that business. Now let's go back to the coffee shop. A year goes by, and the owner used your money, and the money from 999 other people to open 3 new locations. Business is booming. The company is now making way more money than it was before. Because the business is more valuable, your little slice of it is also more valuable. Someone else might see how successful the coffee shop has become and say, "Hey, I want to be a part owner too. I'll buy that share from you for more than you paid for it." If you sell it, you've made a profit. That buying and selling is what happens millions of times a second in the stock market. But instead of a local coffee shop, we're talking about massive companies like Amazon, Google, Walmart, and Tesla. The places where this buying and selling happens are called stock exchanges. You can think of them as the official marketplaces. In the United States, there are two big ones you always hear about. First, you have the New York Stock Exchange, the NYSE. This is the old-school, iconic one. When you see pictures of the trading floor with the big American flag and people in jackets yelling, that's usually the NYSE. It's home to many of the oldest, largest, and most established companies in America. Think Coca-Cola, Johnson & Johnson, Walmart. It has a certain prestige. Then you have the NASDAQ. The NASDAQ is the younger, tech-focused upstart. It was the world's first electronic stock market, meaning there was no physical trading floor. It's famous for being the home of the world's biggest technology companies. Apple, Microsoft, Amazon, Google, Tesla, they all live on the NASDAQ. So the NYSE and the NASDAQ are simply the two major arenas where buyers and sellers meet to trade shares of these companies. Now, a critical question. Why would a successful company like that coffee shop want to sell pieces of itself in the first place? Why would the founders want to give up some of their ownership? This process is called an initial public offering, or IPO. It's when a private company first offers its shares for sale to the public, a process often called going public. They do it for one primary reason: to raise a massive amount of money or capital. That coffee shop owner needed money to expand. A big tech company might need billions of dollars to build new data centers, hire thousands of engineers, or develop the next revolutionary product. An IPO is one of the most effective ways to raise that kind of cash. It's like the ultimate crowdfunding campaign. In exchange for that cash, they give up a percentage of ownership in their company to all the new shareholders. Once a company is public, its shares are traded on an exchange like the NYSE or NASDAQ. And to keep things simple, every single company is given a unique nickname, like a code name. This is called a ticker symbol. It's usually a 1 to 5 letter abbreviation. Apple's ticker is Apple. Ford Motor Company is just F. Amazon is Amazon. Tesla is Tesla. These ticker symbols are the language of the market. They're the shorthand that allows traders and investors to quickly identify a company out of the thousands that are publicly traded. When you see that scrolling ticker at the bottom of a financial news channel, you're seeing the nicknames of companies and the price at which their shares are currently being traded. So let's recap what we've just uncovered. The stock market isn't a mystical casino. It's a marketplace. A stock isn't a lottery ticket. It's a real piece of ownership in a real business. Companies sell these pieces to the public to raise money to grow. And all of this trading happens on organized exchanges, where every company has a unique ticker symbol. You now understand the fundamental what and why of the entire system. You've built the foundation. You're already ahead of the vast majority of people who find this whole world too intimidating to even try to understand. This single idea, owning a small slice of a business you believe in, is the engine that has built incredible wealth for millions of ordinary Americans over the last century. And there is absolutely no reason you can't be one of them. So, if you can own a tiny piece of a massive company, the next logical question is, where do you get it? You can't just walk into an Apple store and say, "I'll take 1 iPhone and 3 shares of the company, please." Doesn't work like that. Instead, all of this buying and selling happens in a specific place. This place is called the stock market. And I know that term, the stock market, can sound incredibly intimidating. It brings up images of guys in suits screaming at each other on a chaotic floor, or complex charts with blinking green and red lines that look like a heart monitor. But I want you to erase that image from your mind. For the rest of this video, I want you to think of the stock market as something much simpler. A giant supermarket. That's it. It's the world's biggest, most incredible supermarket. But instead of selling milk, eggs, and bread, it sells tiny pieces of businesses. Every company you can think of, from the people who made the phone you might be watching this on, to the company that delivered the package you got yesterday, to the brand of soda you drink, they are all on the shelves of this supermarket waiting to be bought. Now, in any supermarket, you have 3 main things. You have the products on the shelves, you have the shoppers, and you have the building itself. Let's break down who's who in the stock market. First, the products. These are the companies themselves. We call their shares stocks. But how do they get on the shelves in the first place? Well, imagine a brilliant local entrepreneur. Let's call her Sarah. Sarah starts a small coffee shop, Morning Grind, and it's amazing. The coffee is the best in town, the service is incredible, and soon there's a line out the door every single day. Sarah has a big dream. She doesn't just want one coffee shop. She wants a Morning Grind in every city in America. But that takes a massive amount of money. She needs to rent new locations, buy expensive espresso machines, hire hundreds of people. She can't fund that from her cash register. So she decides to take her company public. This process is called an initial public offering, or IPO. It's the moment a private company first puts itself on the shelves of the stock market supermarket. Sarah essentially says, I am going to divide my entire company, Morning Grind, into millions of tiny little pieces or shares. And I will sell a portion of those shares to anyone who wants to buy them. The money she gets from selling those first shares is the fuel for her big expansion. And in return, every person who bought a share now owns a tiny fraction of every future cup of coffee Morning Grind ever sells. That is how a company gets on the shelf. They sell pieces of themselves to raise money to grow bigger and better. Next, you have the shoppers. That's you. That's me. That's anyone with a brokerage account who wants to participate. We are the ones walking down the aisles of this giant supermarket, looking at the different companies on display. We're reading the labels, comparing the products, and deciding which ones we believe in, which ones we think will grow and become more valuable over time. When we buy a stock, we are simply taking a product off the shelf and putting it in our shopping cart, which we call a portfolio. Finally, you have the supermarket building itself. The physical, organized, regulated place where all this happens. In the United States, the two most famous supermarket chains are the New York Stock Exchange, or NYSE, and the NASDAQ. Think of the NYSE as the classic old-school supermarket. It's been around for over 200 years and is home to many of America's biggest, most established blue-chip companies. Think Coca-Cola, Walmart, Johnson & Johnson. The NASDAQ is like the newer, sleeker, tech-focused supermarket. It's home to the innovators and disruptors, companies like Apple, Amazon, Microsoft, and Tesla. These exchanges are not a free-for-all. They are highly regulated environments with strict rules. They ensure that the buying and selling is fair, that the prices are transparent, and that companies are honest about their performance. They are the infrastructure that makes this entire system of ownership possible and trustworthy. So, we have companies selling shares to grow, and we have us, the public, buying those shares, hoping to grow our wealth alongside them. This creates a powerful cycle. When we invest in good companies, we give them the capital they need to innovate, to create jobs, and to build the future. And as they succeed, the value of our ownership, our shares, goes up. It's a system designed to reward both the creators and the believers. But this brings us to the most important question of all. What determines the price of a share? Why is one share of company A worth $10 while one share of company B is worth $500? And why does that price change every single second of the day? The answer is beautifully simple. And it's the single most important economic force in the world. Supply and demand. That's all a stock price is. It's a real-time gauge of what thousands of people believe a company is worth. Let's go back to our coffee shop, Morning Grind. Imagine the company is now public, and its stock is trading at $20 per share. Then one morning they announce a revolutionary new brewing technology that makes coffee twice as fast and tastes 10 times better. They also announce a deal to open 500 new stores inside Target locations across the country. What do you think happens? Suddenly, everyone wants to own a piece of Morning Grind. The demand for their stock skyrockets. But there are only a limited number of shares available. A limited supply. When more people want to buy something than there are things to sell, the price gets pushed up. Maybe it jumps from $20 to $25 to $30 a share in a single day, as buyers compete to get their hands on it. Now let's imagine the opposite. What if a news report comes out that Morning Grind's main coffee bean supplier is using unethical labor practices, and a massive customer boycott begins? Suddenly people get scared. They think the company's future is in trouble. They want to sell their shares and get out. The supply of shares for sale floods the market. But who wants to buy them? Very few people. Demand has collapsed. When you have a huge supply and very little demand, the price plummets. The stock might fall from $20 down to $15, or even $10. Every single second the market is open. This dance between supply and demand is happening for thousands of companies. It's a massive collective weighing machine, constantly adjusting prices based on company performance, news, economic data, and human emotion. Good news and strong profits typically increase demand and raise the price. Bad news and poor results typically increase supply and lower the price. Now in this giant supermarket, you can't just yell, "I want to buy some apple." You need to know the product code. Every single publicly traded company has a unique identifier called a ticker symbol. This is usually a 1 to 5 letter code. For example, Apple is Apple. Tesla is Tesla. Ford is just F. Coca-Cola's KO. This is the unique barcode for every company on the shelf, allowing us to find them and trade them instantly and accurately. So let's recap. The stock market is just a giant supermarket where you can buy tiny pieces of businesses. The companies sell these pieces called shares to raise money to grow. We buy them hoping their value increases. This all happens on organized exchanges like the NYSE and the NASDAQ. And the prices are set by the simple, powerful law of supply and demand, tracked by unique ticker symbols. You now understand the fundamental mechanics of the stock market better than 90% of people out there. You understand the what. But a huge problem remains. When you walk into this supermarket, you're faced with thousands upon thousands of companies on the shelves. It's overwhelming. How do you even begin to know where to look? How do you know which aisles to walk down? How do you measure the health of the entire supermarket, not just one single product? It would be like trying to understand the health of the entire American grocery industry by only looking at the price of a single carton of milk. It's impossible. You need a better way. You need a guide. You need a map. Well, in the stock market, those maps exist. They are the most famous numbers you hear on the news every single night. The S&P 500, the Dow Jones Industrial Average, and the NASDAQ Composite. These aren't companies you can buy. They are something else entirely. They are the secret to understanding the market at a glance, and learning how to use them is the next critical step in your journey. So what exactly are these things? The Dow, the S&P 500, the NASDAQ, they sound complicated, but the core idea is actually incredibly simple. Imagine you wanted to know if grocery prices were going up or down across the entire United States. How would you do it? You couldn't possibly track the price of every single item, in every single grocery store, in every single town. You'd go insane. Instead, you'd do something smart. You'd create a representative shopping basket. You'd pick a handful of items that almost everyone buys. A gallon of milk, a loaf of bread, a dozen eggs, a pound of chicken. Then you just track the total cost of that specific basket over time. If the basket cost $50 last month and it costs $52 this month, you don't know what happened to the price of organic kale in Omaha, but you have a really good idea that grocery prices in general are rising. A stock market index is that shopping basket. It's a curated list of stocks bundled together into one number that gives you a quick snapshot of how a particular part of the market is doing. Instead of tracking thousands of individual companies, you can just look at one number and understand the general mood. And the three baskets that matter most, the ones you hear about every single night on the news, are the big three we just mentioned. Let's start with the grandfather of them all. The Dow Jones Industrial Average. Just call it the Dow. The Dow is the old-timer. It's the original, created way back in 1896. Think of it as the market's Hall of Fame. It tracks just 30, that's right, only 30 of the largest, most established, and most historically significant companies in the United States. These are what we call blue-chip stocks. They're the household names you grew up with: Coca-Cola, McDonald's, Disney, Home Depot. These are the titans, the bedrock of American industry. When a news anchor says, "The Dow is up 200 points today," it means that, on average, these 30 colossal companies had a good day. It's a pulse check on the health of corporate America's most legendary players. For over a century, the Dow was the market. It was the only number people cared about. But it has its flaws. Because it only tracks 30 companies, it's not a great picture of the entire economy anymore. The economy is much bigger and more diverse than just 30 giants. It's also calculated using a slightly old-fashioned method called price weighting, which basically means that a company with a higher share price, like $300 per share, has a bigger impact on the Dow's movement than a huge company with a lower share price, like $100 per share, regardless of the company's actual size. It's a quirk, and it's why most professionals today look to our next index for a more accurate picture. That brings us to the most important index in the world, the S&P 500. If the Dow is the Hall of Fame, the S&P 500 is the current all-star team. It's bigger, it's more comprehensive, and it's a much more accurate reflection of the U.S. stock market today. As the name suggests, it doesn't track 30 companies. It tracks 500 of the largest and most influential publicly traded companies in the United States. Think about that. 500 companies. This list includes the 30 from the Dow, but adds 470 other massive players across every single industry you can imagine: technology, healthcare, energy, banking, retail, you name it. Altogether, the companies in the S&P 500 represent about 80% of the total value of the U.S. stock market. It is the true barometer. When financial professionals talk about the market, they are almost always talking about the S&P 500. They'll say things like, "Our fund beat the market this year," which means their investments performed better than the S&P 500. It is the benchmark against which everything else is measured. Unlike the Dow, the S&P 500 is market cap weighted. Don't let the jargon scare you. All it means is that bigger companies have a bigger impact. Apple and Microsoft are two of the biggest companies in the world. So, a big move in their stock prices will move the S&P 500 much more than a big move in one of the smaller companies on the list. This just makes sense. The performance of a $2 trillion company should matter more to the overall economy than the performance of a $20 billion company. So when you hear the S&P 500 was up 1% today, you now know what that truly means. It means that the 500 largest companies in America, representing the vast majority of the U.S. economy, had a positive day. It's the most powerful single number for understanding the health of the U.S. market. Now for our third and final major index. This one has a totally different flavor. It's the NASDAQ Composite. If the Dow is the Hall of Fame and the S&P 500 is the all-star team, the NASDAQ is the high-tech, high-growth rookie squad that's trying to change the world. The NASDAQ is synonymous with one thing: technology and innovation. The NASDAQ Composite is a huge index, including over 3,000 stocks traded on the NASDAQ exchange. But it's heavily weighted towards the technology sector. This is the home of companies like Apple, Amazon, Google, Microsoft, Meta, Nvidia, and Tesla. It's not only tech companies, but they are the dominant force that drives the index's movement. When you hear that the NASDAQ is soaring, it's a powerful signal that investors are feeling very optimistic about the future. They're pouring money into companies focused on growth, innovation, and cutting-edge technology. It's the index that tells the story of progress. Conversely, when investors get nervous about the future or rising interest rates, these high-growth tech stocks are often the first to get sold off, and you'll see the NASDAQ fall more sharply than the other two indexes. So let's put it all together. Why should you, as a beginner, care about any of this? Because these three indexes tell a story, and now you know how to read it. They are not just random numbers. They are the market's vital signs. By looking at how all three are behaving, you can understand the mood of Wall Street in about 5 seconds. For example, if you see the Dow is up a little, the S&P 500 is up a little more, and the NASDAQ is skyrocketing, what does that tell you? It tells you it was a risk-on day. Investors were feeling confident, especially about technology and future growth. What if you see the Dow is flat or even slightly up, but the NASDAQ is down 2%? That tells you a different story. It's a risk-off day. Investors are feeling nervous. They're selling their exciting, high-growth tech stocks and moving their money into the safer, more stable, blue-chip companies in the Dow. They're playing defense. You no longer have to be confused when you hear these terms. You've cracked the code. The Dow is the story of America's industrial titans. The S&P 500 is the broad, true story of the U.S. economy. And the NASDAQ is the story of innovation and the future. You can look at them, you can track them, you can understand the story they're telling. But what if I told you there was a way to not just watch the game, but to buy a ticket for the entire all-star team at once? What if you could own a tiny piece of all 500 companies in the S&P 500 with a single click? That's not just possible. It's one of the most powerful investing strategies ever invented. And it all comes down to two little acronyms: ETF and mutual fund. Let's break down these two power-packed concepts. Imagine you want to make a world-class fruit salad. You could go to the store and painstakingly pick out the perfect apple, the best banana, a flawless orange, a handful of pristine grapes, and so on. This takes time, expertise to know which fruit is ripe, and it can get expensive buying everything individually. Or, you could buy a pre-made fruit basket, curated by an expert, that gives you a little bit of everything all at once. That, in a nutshell, is a fund. A fund is just a professionally managed portfolio, a basket of different investments. Instead of buying individual stocks, you buy a single share of the fund, which in turn owns all the different stocks inside it. The first type of fund, the original fruit basket, is the mutual fund. This idea revolutionized investing for the average person. A company, let's say Fidelity or Vanguard, creates a fund with a specific goal. Maybe it's a large U.S. company's fund, or a technology innovator's fund. They hire a very smart, very expensive manager, a financial chef, if you will. This manager's entire job is to research companies and actively pick the stocks they believe will perform the best, trying to create the most delicious and profitable fruit salad possible. You and thousands of other people give your money to this fund. The fund manager pulls it all together into one giant pile of cash, and uses it to buy and sell stocks according to their strategy. In return for their expertise, the manager and the company take a small percentage of the fund's assets every year. This is called the expense ratio. Think of it as the management fee for their professional services. So the upside is clear. You get instant diversification and a professional managing your money, trying to beat the market. The downside? First, those fees. An expense ratio of 1% might sound tiny, but over 30 or 40 years, that 1% can devour a massive chunk of your returns. We're talking tens, even hundreds of thousands of dollars. Second, you have no control. You're trusting the manager to make the right calls. And third, a weird quirk. You can only buy or sell shares of a mutual fund once per day, after the market closes, at a single calculated price. You can't react to news during the trading day. This is where the new, sleeker, and often cheaper version of the fruit basket comes in, the ETF or exchange-traded fund. ETFs took the brilliant idea of a mutual fund, owning a basket of stocks, and made it trade on the stock market just like a single stock. Think of it like this. If a mutual fund is a special order you place with a chef that gets fulfilled at the end of the day, an ETF is a prepackaged meal you can grab off the shelf at any time. You can buy a share of an S&P 500 ETF at 9:45 a.m. and sell it at 2:15 p.m., just like you would with a share of Apple or Tesla. The price fluctuates all day long. This gives investors incredible flexibility, but the biggest, most important difference isn't how they trade. It's how they are managed. While some ETFs have a manager actively picking stocks, the vast majority of them follow a different philosophy. A philosophy that has been proven to be one of the most effective investment strategies of all time. Passive investing. This brings us to the single most important concept in this entire section. Active versus passive management. Active management, which is what most traditional mutual funds do, is the belief that a smart manager can outweat the market. They are actively researching, buying low, selling high, and trying to pick the winners while avoiding the losers. They are trying to beat the average. They're the star quarterback trying to win the championship. And for that heroic effort, they charge a higher fee. Passive management, on the other hand, says, beating the market is incredibly hard, and trying to do it is expensive. So why don't we just not try? Instead of trying to beat the market, a passive fund seeks only to be the market. It simply aims to match the performance of a specific index, like the S&P 500. How does it do that? It's almost beautifully simple. A passive S&P 500 ETF, for example, is run by a computer algorithm. The algorithm's only job is to own all 500 companies in the S&P 500, in the exact same proportions as the index itself. If Microsoft makes up 7% of the index, the fund holds 7% of its money in Microsoft stock. If a company gets kicked out of the S&P 500 and a new one is added, the fund automatically sells the old one and buys the new one. There's no genius manager making brilliant predictions. There's no high-stakes betting. It's just a robot, calmly and automatically mirroring the market. And because you don't have to pay a team of star analysts and managers the fees, the expense ratios are incredibly, astonishingly low. We're talking fractions of a percent. Instead of 1%, you might pay 0.03%. That difference, compounded over a lifetime, is literally life-changing. Now you might be thinking, wait a minute, why would I want to just be average? I want to win. I want the star manager who's going to beat the market. And that is the great illusion of Wall Street. Here is a fact that might shock you. Year after year, S&P Dow Jones Indices releases a report called the SPIVA report. It stands for S&P Indices versus Active. It's the official scorecard. And year after year, it shows the same brutal truth. Over any long-term period like 10 or 15 years, somewhere between 85% and 95% of active fund managers in the US fail to beat their benchmark index. Let me repeat that because it's that important. The vast majority of the highest-paid, supposedly smartest professionals on Wall Street, who are paid handsomely to beat the average, end up underperforming the simple, boring, automated index fund. Once you factor in their higher fees, they just can't keep up. This is why legendary investors like Warren Buffett have repeatedly said that for most people, the best thing they can do is buy a low-cost S&P 500 index fund. So let's make this real. When we talk about an S&P 500 ETF, we're talking about funds with ticker symbols like SPY, IVV, or VOO. These are three of the biggest and most popular ETFs in the world. If you buy one single share of VOO, the Vanguard S&P 500 ETF, you instantly own a piece of Apple, Microsoft, Amazon, Nvidia, Google, Berkshire Hathaway, and every other company in the index. With one click, for a rock-bottom fee, You have achieved perfect diversification across the 500 largest companies in America. You have effectively bought the U.S. stock market. You are no longer betting on a single company to succeed. You are betting on the long-term success and innovation of the American economy as a whole. And historically, that has been one of the safest and most profitable bets a person can make. So to recap the battle, mutual funds are the classic, often actively managed option with higher fees and less trading flexibility. ETFs are the modern, often passively managed version with ultra-low fees and the ability to trade all day like a stock. For a beginner, the evidence is overwhelming. Starting with a low-cost, broad market index fund ETF is the simplest, most powerful, and most statistically sound way to begin your investing journey. It takes the terrifying question of which stock should I pick, and replaces it with a simple, confident strategy. I'll just own all of them. You've now absorbed the what and the why. You understand the power of owning the entire market through a simple fund. You're ready to take that first step and buy your slice of the economic pie. But a how? Where do you actually go to buy a share of VOO or SPY? You can't just use a credit card on Amazon. You need to enter a specific arena, a gateway to the market that holds all of your investments. This gateway is called a brokerage account, and choosing the right one is one of the most important first decisions you'll make. Because some are built for beginners, while others are a minefield of fees and complexity. Getting this choice right is the next critical piece of the puzzle. So let's break down what a brokerage account actually is. Think of it as a special kind of bank account, but instead of just holding cash, it's designed to hold your investments, stocks, bonds, funds, you name it. It's the essential bridge connecting you, a regular person, to the vast, complex world of the stock market. Without a brokerage, you simply can't buy a share of Apple or invest in an S&P 500 index fund. It's your mission control, your command center for your entire financial future. Now you might be thinking, aren't they all basically the same? And the answer is a resounding no. Choosing a brokerage is like choosing a car. A Ferrari and a Toyota minivan will both get you to the grocery store, but they are built for fundamentally different purposes, different drivers, and come with wildly different costs and complexities. Broadly speaking, you can split brokerages into two main camps. In one corner, you have the sleek, modern, app-first platforms. You've probably heard their names: Robinhood, Webull, and others. They rose to fame by offering zero-commission trades, and their apps are often designed to feel more like a video game than a serious financial tool. They have confetti, slick animations, and they make trading feel fast, exciting, and almost frictionless. This is the Ferrari. It's built for speed, for quick moves, for the thrill of the trade. In the other corner, you have the old guard, the titans of the industry. Think Fidelity, Charles Schwab, and Vanguard. These are the Toyota minivans. They're not necessarily the flashiest. Their websites can sometimes feel a bit dated, a bit corporate, but they are unbelievably reliable. They are packed with safety features, and they are built for the long, steady journey of building wealth over decades. They're not just about buying and selling stocks. They're about financial planning, retirement, and offering a universe of investment options with a ton of research and customer support to back it up. So, which one is right for you? As a beginner, the single most dangerous thing you can do is mistake the Ferrari for the minivan. The platforms designed for high-frequency trading can be a minefield for newcomers. The very features that make them exciting, the ease of use, the gamification, can encourage bad habits. They can tempt you into thinking that investing is about rapid-fire trades, trying to time the market, and gambling on risky options. That is the fastest way to lose your money. For 99% of beginners, the goal isn't to be a day trader. The goal is to be a long-term investor. You want to build the minivan, not the Ferrari. You want the platform that encourages steady, disciplined, long-term thinking. This means your decision should be guided by a few key, non-negotiable factors. First and most importantly, fees. Fees are the silent killer of your investment returns. They are a slow, constant drain on your account that, over decades, can cost you tens or even hundreds of thousands of dollars. Imagine your investment portfolio is a bucket you're trying to fill with water. Your returns are the rain filling the bucket. Fees are a tiny, almost invisible hole drilled in the bottom. In 1 year, you might not notice the small puddle on the floor. But over 30 or 40 years, that slow drip can leave your bucket half empty. While most major brokers have eliminated commission fees for buying and selling US stocks and ETFs, that's not the whole story. You need to watch out for other costs. Are there account maintenance fees? Fees for transferring money? Unusually high fees on certain mutual funds? The big, Reputable brokers like Fidelity, Schwab, and Vanguard are fantastic because they are laser-focused on keeping these costs low. Vanguard, in particular, was literally founded on the principle of minimizing fees for investors. Low fees should be your number one priority. Second, you need to look at the types of accounts they offer. This is a topic that could be its own video series, but the basics are crucial. You don't just open a brokerage account. You open a specific type of account. The most common is a standard, taxable brokerage account. It's straightforward. You put money in, invest it, and when you sell your investments for a profit, you pay capital gains tax on those profits. Simple. But this is where you can unlock a massive advantage. Most major brokers also offer tax-advantaged retirement accounts, and you absolutely need to know about them. The two big ones are the Roth IRA and the traditional IRA. Think of these as special wrappers you can put around your investments that give them tax superpowers. With a traditional IRA, you contribute money before it gets taxed, pre-tax dollars. This can lower your taxable income for the year, which is a nice bonus. Your money then grows tax-deferred for decades. You only pay income tax when you withdraw the money in retirement. So you get a tax break now. A Roth IRA is the opposite, and for many young investors, it's a financial cheat code. You contribute money that you've already paid taxes on, post-tax dollars. There's no immediate tax break. But here's the magic. That money grows completely 100% tax-free. And when you withdraw it in retirement, you pay zero. Nothing. All those decades of compound growth, all those profits, they are all yours free and clear from the IRS. For a beginner with a long time horizon, the power of a Roth IRA is almost impossible to overstate. So, when choosing a broker, you must ensure they offer these accounts and make it easy to open one. The flashy, game-like apps sometimes treat these essential long-term accounts as an afterthought, if they offer them at all. The big, established players build their entire platform around them. Third, consider the range of investment options. As a beginner, you don't need access to complicated derivatives or foreign currency trading. What you do need is access to a wide variety of low-cost index funds and ETFs. We'll dive deep into what those are in the next part, but for now, just know these are the building blocks of a solid, diversified, long-term portfolio. A good broker will offer you thousands of choices, including their own proprietary funds that often have the lowest fees on the market. Fidelity's zero funds, for instance, have zero expense ratios. Schwab and Vanguard are also legendary for their massive selection of world-class, low-cost funds. This is a critical feature that newer, smaller apps often can't compete with. Finally, think about user experience and customer support. Is the platform overwhelming? For a true beginner, the sheer amount of information on a full-service broker's website can feel like trying to drink from a fire hose. But is there a human being you can call if you have a question, or if something goes wrong? When you can't access your account or a trade doesn't go through correctly, you don't want to be stuck dealing with an email-only support bot. Having a 24/7 phone line to a knowledgeable representative is an incredible safety net that you won't appreciate until you desperately need it. So what's the verdict? For the vast majority of people starting out in the United States, the best choice is to open an account with one of the big three: Fidelity, Charles Schwab, or Vanguard. They are the gold standard for a reason. They have rock-bottom fees, a full suite of account types including Roth and traditional IRAs, a massive selection of high-quality investments, and robust customer support. They are the reliable minivans built to safely carry you on your journey to financial independence. Choosing one of these isn't the flashy choice. It's the smart choice. It sets you up on a path of disciplined, long-term investing, rather than speculative, short-term gambling. You are building the foundation for your entire financial life. Don't build it on a flashy, unproven platform designed to exploit your worst behavioral biases. Build it on the bedrock of a trusted, long-standing institution. Making this decision is the final step in setting up your infrastructure. You've learned the mindset, you understand the market's purpose, and now you have the command center, your brokerage account, ready to go. The engine is built, the fuel is in the tank. Now the big question remains, what do you actually buy? How do you take your hard-earned dollars and turn them into a piece of the world's greatest companies? That's where we turn from setting up the game to actually playing it. And it all starts with understanding the single most powerful investment vehicle ever created for the average person: the exchange-traded fund, more commonly known as the ETF. Now, that sounds like some Wall Street jargon designed to confuse you, but I promise you by the end of this, you'll understand it better than 90% of the population. And you'll see why it's not just an investment vehicle. It's a key that unlocks the entire stock market for you. without needing a PhD in finance or a crystal ball. So let's break down the name itself. Exchange. Traded. Fund. Fund is the most important word here. A fund is simply a collection of things. Think of it like a basket. Instead of holding one apple, this basket holds hundreds of different kinds of fruit. Traded means you can buy and sell this entire basket of fruit just as easily as you could buy or sell a single apple. Trades like a regular stock. And exchange just means this all happens on the major stock exchanges, like the New York Stock Exchange, right alongside shares of Apple and Coca-Cola. So an ETF is a basket of stocks that you can buy and sell with a single click. But why is that so revolutionary? Let me give you an analogy. Imagine the entire US stock market is a gigantic supermarket, a Costco or a Walmart supercenter. There are thousands of aisles, tens of thousands of products on the shelves. Each product is a single company's stock. There's the Apple aisle, the Microsoft aisle, the aisle for some brand new tech startup you've never heard of. It's overwhelming. You walk into this giant store with your hard-earned $100. Your goal is to buy the best combination of groceries that will not only feed you today but will grow in value over time. What do? You could spend weeks, months, years studying every single product. You could read the nutritional labels on everything, compare the price per ounce, try to predict which new organic kale brand is going to be a hit and which ones will spoil on the shelf. You might get lucky. You might pick the next superfood. But you could also very easily pick a dud. Product that gets recalled. A company that goes out of business. You could put your whole $100 on one brand of fancy water that everyone's talking about, only to see it flop a month later. Your $100 is gone. That's the risk of trying to pick individual stocks. It's incredibly difficult, time-consuming, and for most people it's a losing game. Now what if there was another option? What if, at the front of the store, there was a pre-packaged shopping cart? This cart was assembled by a team of world-class professional shoppers. Inside, they've put a tiny piece of almost every single item in the entire store. A sliver of an apple, a crumb of a cracker from the snack aisle, a single coffee bean, a tiny piece of steak from the butcher. They've perfectly balanced this cart to represent the entire supermarket. You don't have to go down a single aisle. You don't have to guess which product is best. You just walk up to the front, and with your $100 you buy that entire prepackaged cart. That cart is an ETF. Specifically, it's what we call an index fund ETF. It doesn't try to pick winners, just buys everything. And by buying that one cart, you instantly own a piece of the entire store. Now, if one product, let's say that fancy water, goes bad and gets pulled from the shelves, it doesn't matter to you. It was such a tiny microscopic piece of your overall cart that you barely even notice. But if the store as a whole, the entire US economy, does well, your cart, which represents the entire store, goes up in value. This single idea is called diversification. And it is the closest thing to a golden rule in investing. Don't put all your eggs in one basket. The ETF doesn't just give you a second basket. It gives you 1,000 baskets, all wrapped up in one easy-to-buy package. This is the opposite of what you see in movies. It's not about some hot tip or some wild bet. It's about owning the whole haystack, so you don't have to waste your life looking for the needle. So let's get specific. The most famous shopping cart in the world is the S&P 500 Index Fund ETF. The S&P 500, or Standard & Poor's 500, is just a list. It's a list of the 500 largest and most influential public companies in the United States. Think of it as the all-star team of American business. It includes companies you use every single day. Apple, Microsoft, Amazon, Google, Meta, Tesla, Johnson & Johnson, Visa, Home Depot, McDonald's. When you buy one share of an S&P 500 ETF, and there are several popular ones with ticker symbols like SPY, IVV, or VOO, you are not buying one thing. You are buying a tiny fractional share of all 500 of those companies all at once in one transaction. You instantly become a part owner of the engine of the American economy. When you see a news report that says, "The market was up today," they are almost always talking about the S&P 500. It is the single best benchmark for the health of the US stock market as a whole. And by buying an S&P 500 ETF, you are essentially saying, I don't know if Apple will beat Microsoft next year, or if Tesla will beat Ford. And I don't care. I am just making one simple bet. That over the long term, the 500 best run, most innovative, most powerful companies in America will, as a group, continue to innovate, grow, and become more valuable. Historically, that has been the safest, most reliable bet you can make. This strategy is called passive investing. You're not actively trading day to day. You're not trying to outsmart the market. You are simply buying the market itself and letting the power of broad economic growth do the heavy lifting for you. The alternative is active investing, where a fund manager, or you, tries to actively pick and choose stocks to beat the market average. It sounds good in theory, but the data is overwhelming. Over any long-term period, the vast majority of professional, highly paid active fund managers fail to beat the simple, boring S&P 500 index. They go to all that work, charge you high fees for their expertise, and still end up with worse results than if they just bought the whole cart. Even the greatest investor of all time, Warren Buffett, has famously said that for the average person, the best thing to do is to consistently buy and hold a low-cost S&P 500 index fund. And that brings up the final beautiful piece of the puzzle, the cost. How much does it cost to have these experts assemble this perfect shopping cart for you? Almost nothing. The fees for these major index fund ETFs are microscopic, often as low as 0.03%. That means for every $10,000 you invest, you're paying a fee of just $3 per year. It is an unbelievably good deal. So let's recap the power of this one idea. With a single purchase, a beginner investor gets 1. Instant diversification across the 500 biggest companies in America, dramatically reducing your risk. 2. Simplicity. You don't have to research hundreds of companies. You just buy one thing. And 3. Extremely low cost, so more of your money stays in your pocket working for you. This is why the ETF is the most powerful vehicle for the average person. It took a system that was complex, risky, and expensive and made it simple, safer, and incredibly cheap. It leveled the playing field, giving you the same basic tools as the most sophisticated investors on Wall Street. Now, of course, there are thousands of different ETFs. There are ETFs that track the entire world stock market, not just the US. There are ETFs that focus only on the tech sector, or the healthcare sector, or on dividend-paying stocks, or on bonds. The supermarket has thousands of different pre-made carts for every possible taste. But for a beginner, the broad market index fund like the S&P 500 is the cornerstone. It's the foundation upon which wealth is built. It's the simple, powerful, proven starting point. You now understand the what and the why. You have the vehicle, but buying it is just the first step. How do you know if it's working? How do you read the map? When you see the S&P 500 is at 4,500, or that the market is up 1%, what does that actually mean for your money? Understanding those numbers and learning to read a basic stock chart without fear or confusion is the next crucial piece of the puzzle. It's time to learn how to track your journey. When you hear a news anchor say the market is up 1%, they're almost always talking about a market index. Think of an index as the market's report card. Instead of tracking all 6,000 plus stocks individually, which would be impossible, an index tracks a specific representative group of them to give you a quick snapshot of the overall mood. There are 3 main report cards you'll hear about every single day in the United States. First, there's the S&P 500. This is the big one. It tracks the 500 largest and most influential publicly traded companies in the US. Think Apple, Microsoft, Amazon, Johnson & Johnson. Because it's so broad and diverse, the S&P 500 is considered the best single gauge of the large-cap US stock market. When someone says the market, they usually mean the S&P 500. It's the benchmark against which most professional investors measure their success. Second, you have the Dow Jones Industrial Average, or just the Dow. This is the old-timer. It's been around since 1896. But here's the thing. Despite its famous name, it only tracks 30 large, well-established companies. 30. Companies like Coca-Cola, Boeing, and Goldman Sachs. Because it's such a small sample size and uses a quirky price-weighting method, most professionals don't see it as the best representation of the market anymore. But because of its history, it still gets a ton of media attention. And third, there's the NASDAQ composite. If the Dow is the old guard, the NASDAQ is the new kid on the block, full of energy and innovation. It tracks over 3,000 stocks, but it's heavily weighted towards technology. Think Google, Tesla, and Meta. When you hear that tech stocks are having a great day or a terrible day, the NASDAQ is the index that tells that story most clearly. So, when the S&P 500 is up 1%, it means that, on average, the value of those 500 massive companies has increased by 1%. This gives you the big picture view, the satellite image of the entire forest. But what about the individual trees? How do you track the journey of a single company you've invested in? For that, we need to look at its stock chart. Now I know what you're thinking. A stock chart looks like a heart monitor during a panic attack. It's a chaotic mess of jagged lines, weird colored bars, and numbers that seem to make no sense. Feels intimidating. Feels like it's for math wizards and Wall Street traders only. I am telling you right now that is not true. A stock chart is just a story. It's a visual story of a company's performance and the emotions of its investors, told over time. And you only need to understand a few basic elements to read the headlines of that story. Let's break it down. The absolute basics. Every chart has two axes. The line running up and down on the side, the vertical axis, is the price. Higher up means a higher price, lower down means a lower price. Simple. The line running across the bottom, the horizontal axis, is time. It could be showing you minutes, days, weeks, months, or even years. Price and time. That's it. That's the canvas. Now for the painting itself. The most basic image you'll see is a simple line chart. All this line does is connect the dots of the stock's closing price at the end of each time period. If you're looking at a daily chart, the line connects the closing price from Monday to Tuesday to Wednesday and so on. It gives you a clean, simple overview of the general direction the stock has been moving. Is the line generally going up and to the right? The stock is in an uptrend. Is it going down and to the right? It's in a downtrend. But a simple line leaves out a lot of the drama. To get more detail, we need to look at two other crucial pieces of information that are on almost every stock chart. The first is volume. Look at the bottom of the chart. You'll see a series of vertical bars, usually green and red. This is the volume. Volume simply tells you how many shares of that stock were traded during that period. Why does this matter? Because volume measures conviction. It measures enthusiasm. Imagine you see a stock's price jump up by 5%. If the volume bar for that day is tiny, it means not many people were involved. It was a quiet move. It's like one person in a library whispering a rumor. But if the price jumps 5% and the volume bar is a giant skyscraper, towering over the previous days, that means millions of shares were trading hands. The entire market was shouting. It tells you that a huge number of investors believed in that move. High volume validates the price action. It's the difference between a suggestion and a declaration. The second and most important visual element is the candlestick. Instead of a simple line connecting closing prices, most traders use what are called candlestick charts. And they're not as complicated as they look. Each little candle tells the story of a single time period, like one day of trading. Think of it as a tug-of-war between the buyers, who want the price to go up, and the sellers, who want the price to go down. A candle has a main, thick part called the body. If the body is green, it means the price closed higher than it opened for that day. The buyers won the tug-of-war. It was a positive day. If the body is red, it means the price closed lower than it opened. The sellers won. It was a negative day. The bottom of the body shows you where the price opened, and the top shows you where it closed for a green candle. For a red candle, it's the opposite. The top is the open and the bottom is the close. These candles give you a much richer, more immediate visual story than a simple line. At a glance, you can see not just the direction, but the momentum and the sentiment of each trading day. A chart full of long green candles tells a story of strong, confident buying. A chart full of long red candles tells a story of panic and selling. Okay, so we have price, time, volume, and candlesticks. There's one last tool for beginners that is incredibly helpful for cutting through the noise. The simple moving average, or SMA. The day-to-day movement of a stock can be chaotic. It zigs and zags. A moving average smooths all of that out to show you the underlying trend more clearly. A 50-day moving average, for example, is a line on your chart that represents the average closing price of the stock over the last 50 days. Think of it like this: tracking the exact temperature every single day gives you a lot of noisy data. It's 75 one day, 68 the next, 78 after that. But if you looked at the average temperature for the whole month, you'd get a much clearer picture of whether it's spring, summer, or fall. The moving average does the same for a stock. It's a smooth, flowing line that cuts through the daily volatility. When the current stock price is trading above its moving average line, it's generally considered to be in a healthy uptrend. When it's trading below the line, it's generally in a downtrend. It acts as a simple visual guide to the overall momentum. So let's put it all together. You pull up a chart for a company. You see a series of long green candles, showing that buyers are in control. You see that the price is consistently staying above its 50-day moving average line, which is sloping upwards. And you look down and see that the volume bars on the green days are much taller than on the red days. Without knowing anything else, what story is this chart telling you? It's telling you that this stock is in a strong, healthy uptrend, supported by a large number of enthusiastic investors. You've just performed basic chart analysis. You've read the story. You now know how to get the big picture view with indexes like the S&P 500, and how to read the specific story of an individual stock through its price, its volume, its candlesticks, and its moving average. You've learned the alphabet and the basic vocabulary of the market's language. But reading the words is one thing. Understanding the grammar, the sentences, the paragraphs, that's the next step. How do you use this information to spot a potential change in the story? How do you identify the key price levels where the battles between buyers and sellers are most intense? We've learned to read the map. Now it's time to learn how to spot the major landmarks and intersections on that map. These landmarks are called support and resistance. And they are, without exaggeration, the single most important concept you will ever learn in technical analysis. Forget everything else if you have to, but burn this into your brain. Because support and resistance are the language of the market. They tell you where the story is likely to pause, where it might reverse, and where a new chapter is about to begin with explosive force. Let's start with a simple analogy. Imagine you're in a room with a floor and a ceiling. You drop a rubber ball. It falls until it hits the floor, then it bounces back up. The floor is support. It stops the price from falling further and pushes it back up. Now the ball flies upward until it hits the ceiling, and it's rejected, falling back down. The ceiling is resistance. It stops the price from rising higher and pushes it back down. That's it. That's the entire concept in a nutshell. A price chart is just a record of this ball bouncing between floors and ceilings over and over again. Our job is to figure out where that floor and ceiling are. Let's dive deeper into support. Support is a price level where demand is thought to be strong enough to prevent the price from declining further. Think of it as the buyer's fortress. When the price of a stock falls to a certain level, it starts to look like a bargain. Buyers who were waiting on the sidelines see an opportunity. They think, wow, this is cheap. Time to buy. At the same time, sellers who were driving the price down start to think, maybe I've pushed it far enough. I'll take my profits now. The combination of new buyers flooding in and sellers disappearing creates a powerful force, a wall of demand. The price hits this wall and more often than not bounces. How do you spot this fortress on a chart? You look for the valleys. You scan the chart to the left and find a price level where the stock has fallen to before, and then reversed and went back up. If it happened once, it's interesting. If it happened twice, it's a pattern. If the price has fallen to that same level 3 or more times and bounced back up each time, you found a major support level. The market has memory. It remembers that this price was a good deal in the past, and it tends to treat it as a good deal again. The more times a support level is tested and holds, the stronger and more significant it becomes. It's like tapping on a wall. A few taps and you're not sure. But if you keep hitting it and it doesn't break, you know it's solid. Now let's talk about the ceiling, resistance. Resistance is the exact opposite of support. It's a price level where selling pressure is strong enough to overcome buying pressure, causing the price to turn back down. This is the seller's stronghold. As the price climbs, it eventually reaches a point where investors start to think it's overvalued or expensive. People who bought at lower prices see a juicy profit and decide it's time to sell and lock in their gains. At the same time, potential new buyers look at the high price and think, no way, that's too expensive for me right now. I'll wait for it to come back down. So you have a flood of sellers cashing out, and a drought of new buyers coming in. This creates a wall of supply. The price rallies up to this wall, hits it, and gets rejected. How do you find it on a chart? You look for the peaks. You scan to the left and find a price where the stock has risen to before, only to be smacked back down. Just like with support, the more times a price level has acted as a ceiling, repelling the price back down, the stronger and more significant that resistance level is. It's a battle-tested line in the sand that the sellers are determined to defend. So now you can look at a chart and identify the buyer's fortress and the seller's stronghold. You can see the price bouncing between them, trapped in what traders call a range or consolidation. This is incredibly valuable information. It gives you a framework. It tells you where the key battles are being fought. But here is where it gets truly fascinating. Here is the plot twist that changes everything. What happens when the fortress is finally breached? What happens when the ceiling shatters? This is where fortunes are made and lost, and it's based on a powerful psychological principle. Let's imagine a strong support level at $100. The price has bounced off it 3 times. Thousands of buyers have placed their orders there, confident it will hold again. But this time some bad news comes out. Panic sets in. A massive wave of selling hits the market, and the price smashes right through that $100 support level and plummets down to $90. Now, think about every single person who bought at $100. What are they feeling? They're feeling regret. They're feeling pain. They're staring at a loss. All they want is for the price to get back to what they paid for it so they can sell and get their money back without losing anything. They are no longer hopeful buyers. They are now desperate, trapped sellers in waiting. So, if the price does manage to rally back up to $100, what happens? That massive group of buyers who are now underwater all rush to sell at their break-even point. Their collective selling creates a huge wall of supply right where the buyer's fortress used to be. The old support level has now become a new resistance level. This is a profound, game-changing concept called role reversal. Old support becomes new resistance. And it works the exact same way in reverse. Imagine a strong resistance level at $120. The sellers have defended it successfully multiple times. But this time some incredible news comes out. A wave of buying enthusiasm explodes into the stock, and the price blasts right through that $120 ceiling and runs up to $130. Now think about all the sellers who shorted the stock or sold their shares at $120. What are they feeling? Panic. Regret. They made the wrong decision. The buyers were right. As the price keeps climbing, their desire to get back in grows. If the price ever dips back down to $120, they see it as a second chance. They think, this is my opportunity to buy back in at the price I sold at. Their buying, combined with new buyers who see the breakout as a sign of strength, creates a massive wall of demand. The old resistance, the old ceiling, has now become the new support. The old ceiling is now the new floor. This principle of role reversal is the engine of trends. A downtrend is simply a series of support levels breaking and turning into resistance. An uptrend is a series of resistance levels breaking and turning into support. By identifying these key horizontal lines on your chart, you can understand the very structure of the market's movement. And here's a pro tip. Support and resistance are rarely a single razor-sharp price. It's more realistic to think of them as zones or areas. A stock might find support not at exactly $100, but in the zone between $99 and $101. Don't get fixated on an exact number. Look for the general area where the price reacts. Also, pay close attention to big, round numbers. $50, $100, $500. These act as powerful psychological support and resistance levels simply because humans are wired to think in round numbers. Big institutions will place huge orders around these levels, and news headlines will often anchor to them, making them self-fulfilling prophecies. So now you have the map. You can see the major landmarks. You know where the buyers have built their forts and where the sellers have established their strongholds. You understand the incredible power of a broken level flipping its role and becoming the opposite. You can now see the battlefield with a clarity you never had before. But this raises a critical new question. Knowing where the battlefield is located is one thing. But how can we tell who is winning the battle right now? How do we measure the strength of the buyer's advance or the ferocity of the seller's defense? Is the price approaching a support level weekly, ready to collapse through it? Or is it rocketing towards a resistance level with so much force that it's likely to shatter it? Just knowing the levels isn't enough. We need a way to gauge the momentum, the power, and the energy behind the price moves. We need to bring in our advanced reconnaissance tools. And that's where we turn to the most popular tools in a trader's arsenal: technical indicators. Think of technical indicators as the advanced dashboard for your stock market vehicle. Price and volume are your speedometer and your fuel gauge, essential, but they don't tell the whole story. Indicators are your tachometer, your oil pressure gauge, your engine temperature. They give you a deeper look under the hood to see how healthy the current move really is. They are not crystal balls. I want you to burn that into your brain. They are mathematical calculations based on a stock's past price and volume, designed to help us make more educated guesses about where it might be heading next. They help us see patterns that are invisible to the naked eye. Let's start with the undisputed king of all indicators, the one that every single professional on Wall Street watches: the moving average. It's elegant in its simplicity. A moving average smooths out the chaotic, day-to-day price fluctuations to show you the underlying long-term trend. Imagine a stock chart is a jagged, rocky mountain range. The moving average is like a ski lift cable running through it. It ignores the small peaks and valleys and shows you the general direction of the mountain. The two most famous moving averages are the 50-day and the 200-day. The 50-day represents the medium-term trend, about 2 months of trading. The 200-day represents the long-term trend, about 9 months of trading. Think of the 200-day moving average as the great dividing line. When a stock's price is trading above its 200-day moving average, it's generally considered to be in a healthy, long-term uptrend. When it's trading below it, it's in a long-term downtrend. It's that simple. But the real magic happens when these two lines interact. When the shorter-term 50-day moving average crosses above the longer-term 200-day moving average, it's a legendary bullish signal known as a golden cross. This is a powerful sign. It suggests that the medium-term momentum has become so strong that it's now overtaking the long-term trend, signaling a potential new, major uptrend. It's like the market's changing of the guard, where the bulls have officially seized control from the bears. Conversely, when the 50-day moving average crosses below the 200-day moving average, it triggers the signal that sends shivers down investors' spines, the dreaded death cross. This is a major bearish signal, suggesting the medium-term downtrend is accelerating and a significant, prolonged price decline could be on the horizon. These two signals, the golden cross and the death cross, are some of the most widely watched technical events in the entire market. They don't always work, but when they appear, everyone pays attention. So, moving averages tell us about the trend. But what about the energy behind the trend? Is the trend running out of steam? Is it just getting started? For that, we need an oscillator, and the most popular one is the Relative Strength Index or RSI. The RSI doesn't measure the absolute price. It measures the speed and magnitude of recent price changes. In simple terms, it tells you if a stock is being bought up or sold off too aggressively, too quickly. The RSI is measured on a scale from 0 to 100. The key levels to watch are 70 and 30. When the RSI moves above 70, the stock is considered overbought. This means the stock has gone up so much so fast that it might be due for a pause or a pullback. It's like a sprinter who's been running at full speed for too long. They're going to need to catch their breath. When the RSI drops below 30, the stock is considered oversold. The selling has been so aggressive that the stock might be due for a bounce. The bears have pushed the price down so far, they might be getting exhausted. Now, here's the critical warning for beginners. Overbought does not mean sell immediately, and oversold does not mean buy immediately. This is a trap that snares so many new traders. A powerful, trending stock can stay overbought for weeks, or even months as it keeps climbing higher. And a weak, dying stock can stay oversold for just as long as it continues to plummet. Think of the RSI not as a red or green light, but as a yellow light. When a stock becomes overbought or oversold, it's simply the market telling you to pay closer attention. It's a warning sign that the current move might be getting stretched a little too thin. We have our trend follower with moving averages. We have our momentum gauge with the RSI. But we're still missing the single most important confirmation tool in all of technical analysis. We need to know if the big money, the institutional players, are participating in a move. And for that, we look at volume. Volume is simply the number of shares that are traded in a given period, usually one day. It's represented by the vertical bars at the bottom of your stock chart. And it is, without a doubt, the market's truth serum. Price can lie, but volume rarely does. Volume tells you how much conviction is behind a price move. Let me give you two scenarios. In scenario 1, a stock's price breaks out above a major resistance level, a ceiling it has failed to break for months. You look down at the volume bars and you see a massive spike. The volume is 3 or 4 times higher than its daily average. What is that telling you? It's telling you that thousands of investors, including the big Wall Street funds, saw that breakout and stampeded in to buy. That is a powerful high-conviction breakout. It has a much higher probability of succeeding because it has the fuel of immense buying pressure behind it. Now, scenario 2. The same stock breaks out above the same resistance level. But this time you look down at the volume and it's pathetic. It's lower than average. It's a tiny little bar. What does that tell you? It tells you that almost nobody cared. There was no conviction, no stampede of buyers. It was a weak, anemic move that just barely managed to crawl over the line. This kind of low-volume breakout is far more likely to be a fake-out, a trap that quickly reverses and falls back down. Always remember this. Volume confirms the trend. A rising price on rising volume is healthy and bullish. A falling price on rising volume is a warning sign of heavy selling pressure. Any significant price move up or down that occurs on low volume should be viewed with extreme suspicion. Now, the most crucial lesson of this entire section. No single indicator is a magic bullet. Using just one is like trying to navigate a city with only a compass. You'll know which way is north, but you have no idea what streets to take. The real power comes from what traders call confluence. when multiple different indicators all start telling you the same story. This is where you graduate from just looking at a chart to actually reading it. Imagine you're analyzing a stock. You notice the price has just broken out of a beautiful consolidation pattern. That's your first clue. You look down and see that the breakout happened on massive volume. That's your second powerful clue. You check the moving averages, and you see a golden cross just formed 2 weeks ago, confirming the long-term trend has shifted to bullish. That's your third clue. You glance at the RSI, and you see it's rising strongly but isn't yet in overbought territory, meaning there's still room for the stock to run. Do you see what's happening here? The price action, the volume, the moving averages, and the momentum oscillator are all aligned. They are all singing the same song. This doesn't guarantee the trade will be a winner. Nothing ever does. But it dramatically stacks the probabilities in your favor. You've moved from a random guess to a well-reasoned high-probability setup. This is the essence of technical analysis. Using these tools not to predict the future, but to identify moments in the present where the odds are tilted in your favor. But using these tools is one thing. Knowing exactly when to buy, how much to risk, and when to sell is a completely different discipline. We've learned how to find a good company through fundamental analysis. We've learned how to read its story through technical analysis. Now we need to combine it all into a coherent plan. How do we manage the single most important factor in our long-term success? Our own risk. How do we build a framework that protects us from catastrophic losses while allowing our winning stocks the room they need to grow into something truly special? That final, critical piece of the puzzle is where we build our fortress. This fortress isn't built with bricks and mortar, but with rules and discipline. It's the one thing that separates the gambler from the investor. It's the system that keeps you in the game long enough to win. This is risk management, and it's the most important lesson of this entire series. Forget everything else if you must, but do not forget this. The first pillar of our fortress is something called position sizing. This is the art of deciding how much to invest in any single idea. Most beginners get this catastrophically wrong. They find a stock they love, a story that captivates them, and they throw a huge chunk of their savings at it, betting the farm on a single outcome. That's not investing. That's a lottery ticket. Professional thinks differently. They ask, how much of my total capital am I willing to lose if I am completely and utterly wrong about this stock? The most time-tested rule for beginners is the 1% rule. It's simple, it's powerful, and it will save you from ruin. It states, you should never risk more than 1% of your total investment portfolio on a single trade. Let's make this real. Imagine you have a $10,000 investment account. According to the 1% rule, the absolute maximum amount of money you can lose on any single stock idea is 1% of that, which is $100. Now, here is the crucial part that most people misunderstand. This does not mean you only buy $100 worth of the stock. Your risk is not the same as your investment size. This is the key that unlocks everything. Your risk is determined by the second pillar of our fortress, the stop loss. A stop loss is an automatic sell order you place with your broker. It's your ejection seat. It's your predefined point of failure. You decide, before you even buy the stock, the exact price at which your idea is proven wrong. If the stock falls to that price, your broker automatically sells your shares for you, capping your loss. There's no emotion, no hesitation, no, oh, but maybe it'll bounce back. The decision was already made when you were calm and rational. So let's put the two pillars together. You have your $10,000 account, so your maximum risk is $100. You've done your analysis on a company, let's call it Apex Innovations, and it's currently trading at $50 per share. You believe it's going up, but you've also looked at the chart. You see a clear support level at $45. You decide that if the stock breaks below that support level, your analysis was wrong, and it's time to get out. So you set your stop loss at $45. Your entry price is $50. Your exit price, your point of I was wrong, is $45. That means you are risking $5 per share. Now the magic happens. You take your total allowed risk, $100, and you divide it by your risk per share, $5. 100 divided by 5 is 20. That means you can buy 20 shares of Apex Innovations. Think about what we just did. You are buying 20 shares at $50 each, for a total investment of $1,000. But your actual risk, the amount you will lose if your stop loss is hit, is only $100. You have a $1,000 position, but you're only risking 1% of your account. This is how professionals control their destiny. It allows you to take meaningful positions in companies you believe in, without exposing yourself to a catastrophic loss that could wipe you out. If you're wrong 10 times in a row, which is a terrible losing streak, you've only lost 10% of your account. You are still in the game. The amateur who bet the farm on one stock is gone. This framework forces discipline. It forces you to admit when you're wrong and to do so cheaply. The single greatest destroyer of wealth for new investors is the inability to take a small loss. We buy a stock, it goes down, and our ego gets involved. We think, it has to come back. I did the research. I can't sell for a loss. That small, manageable loss then turns into a devastating, portfolio-crushing loss. The stop loss is your defense against your own worst enemy, your own emotional brain. But risk management is a double-edged sword. While we are ruthless about cutting our losses, we must be incredibly patient with our winners. This is the beautiful, powerful asymmetry of the stock market. When you buy a stock, the most you can possibly lose is what you invested. If you buy it at $50, it can only go to zero. Your loss is capped at 100%. But your upside? Your upside is limitless. A stock can go up 200%, 500%, 1000% or more. Your goal is to find trades where your potential reward is many times greater than your risk. If you are risking $5 a share on Apex Innovations, you should have a realistic belief that it could go to $65, $70, or $75. You are making small bets for the chance at massive wins. This is why you never ever sell a stock just because it's gone up a little. You let your winners run. Let them do the heavy lifting for your portfolio. One great winner can pay for a dozen small losses. How do you do this without letting a big gain turn back into a loss? One advanced tool is a trailing stop loss. Instead of a fixed price, it's a percentage that trails below the stock's highest price. If the stock goes up, your safety net moves up with it, locking in profits but giving it room to keep climbing. If it turns around and falls by that set percentage, you automatically sell, protecting the majority of your gains. So here we are at the end of our journey together. We started with the simple idea of what a stock is, a piece of a business. We learned how to analyze that business through its fundamentals to understand its story. We learned to read the market's own language through technical analysis, spotting trends and patterns on the charts. We combined these two worlds to build a robust thesis, a reason to believe a stock is poised to move. And now, finally, we have built the fortress around our capital. A system of rules, position sizing, and stop losses that protects us from our own emotions and keeps us in the game for the long haul. This is your complete beginner's framework. It is not a collection of hot tips or secret formulas. It is a process. It is a mindset. I want you to take what you've learned and create your own simple one-page investment plan. Write it down. What kind of companies will you invest in? What are your entry signals? What is your non-negotiable exit rule if you are wrong? How will you manage your winning trades? The real secret to success in the stock market isn't some magic indicator. It's consistency. It's the discipline to follow your plan, day in and day out, even when it's boring, even when you're scared, even when you're greedy. You will make mistakes. Everyone does. But with this framework, your mistakes will be small, affordable tuition payments to the school of the market. And your victories will have the space they need to grow into something that can fundamentally change your financial future. You now know more than 95% of the people who blindly throw their money into the market hoping for the best. You have the tools. You have the knowledge. You have the framework. The path forward is no longer a mystery. Start small. Practice. Learn. The stock market is the greatest engine for wealth creation the world has ever known. And the barrier to entry has never been lower. It's a story being written every single day. And you now have the tools to not just read it, but to write your own chapter. Go build your future.